Good morning. Thank you to everyone that has joined the webinar this morning. My name is Eva Majorova, and I look after investment consulting and the Itrix business at Sygnia Asset Management. So this morning, we are very excited to launch our 12th ETF on the Johannesburg Stock Exchange. This ETF tracks the MSCI Emerging Markets 50 Index. So it's all about emerging markets. This morning's presentation will give you an insight into what you can expect out of this product, out of this ETF, and I will provide you with some general information as to why emerging markets are an attractive investment at the moment. At the end of the session, depending on how much time is left, I will answer a couple of questions, but if I don't get to your questions today, then I will respond to every single one over email. So please type your questions in the question box, and then I will try to cover as many of them as possible at the end of the session. So to start off, I will explain what ETFs are, why they're attractive, how the instrument works, just initially to provide some educational content. I do appreciate that not everybody is comfortable with how the instrument works and what it's all about, and I would love it if every single South African could invest into ETFs. It's so simple, it's so easy, it's so cost effective. So please do ask me questions about general, even just about the instrument or anything else that I may be able to assist you with. So an ETF stands for Exchange Traded Fund. So what is it? It's a collection of instruments that track an index. So it could be a basket of bonds, it could be a basket of stocks, or it could be just a single commodity like oil or gold, and you just track the price of the commodity. So let's think about stocks, because today we're talking about equities, we're talking about emerging market equities in specific. So if you think about a collection of stocks, so let's think about the Swiss 40 index, so the top 40 stocks in the Swiss. If that is your collection of stocks, that whole collection is the ETF. So it's a basket of securities. And what the ETF is trying to achieve is to track the performance of an index. How it does that is by purchasing every single one of the holdings in the index. And that way we're able to replicate the performance of an index. So there's quite a nice graphical representation here that sums it up. So it's really your collection of, be it stocks or bonds or any other assets, that's trying to replicate the movement of an index. ETFs and mutual funds are very similar. So mutual funds are essentially unit trusts. We're more comfortable with that term in South Africa. And the one main difference between ETFs and unit trusts is that ETFs can be bought and sold throughout the day. You can trade them at any time throughout the day, whereas mutual funds trade only once a day. So I've pretty much summed up what the definition is, but again here in words is an exchange traded fund is really just a unit trust that trades on the exchange. It's governed by the same regulations, so the Collective Investment Schemes Controls Act, so there are CISCA regulations. So it is a basket of securities, and it seeks to mirror the performance of the index. Now, if the securities in the index perform well, then your ETF will perform well. If there are times of volatility, of course, we know markets are not always going up, unfortunately, so there's times where they do go down. If the basket of securities happens to underperform over a certain period, then your ETF will underperform as well. Now, how long have these instruments been around? Well, passive investing in general has been around since the 70s. But at that time, if people wanted to invest in passive strategies, they had to do so via funds that were often very complex, they were expensive, they were illiquid. And then the industry decided to design a different instrument that may be more practical. And that's how the ETF was born, by thinking about passive investing and how better to access passive instruments. The first ETF was traded on the Toronto Stock Exchange back in 1990. So it's a long, long time ago. Today we find ourselves 30 years later, And there are so many ETFs out there that your offering is just incredible. You can track pretty much any market index, even very niche sectors. So there really is, you know, hardly anything out there that you cannot track through an index. So many different products out there. And really, if you think about why it's so attractive to do it via an ETF, you often hear people saying when it comes to investments that you should not put all your eggs in one basket. Well, an ETF offers you the benefit of being able to invest in one instrument, but that instrument itself is a whole basket of securities. Now, I started off by explaining that ETFs and unit trusts are similar in a sense, except the one is tradable on an exchange. They're similar provided that they're both tracking the same index. You do, of course, have a lot of actively managed unit trust as well, but for the purposes of comparison, if you think about an ETF that might be tracking an index and a unit trust tracking the same index, what are some of the differences? Well, as I mentioned, ETFs do trade continuously throughout the day. The benefit of that is that you can implement investment decisions very quickly. The access is through platforms such as the Sygnia platform or Easy Equities or any other platforms out there, or you could access it via a stockbroking account. Liquidity is guaranteed by a market maker, so we work with a big market maker called Jane Street. And of course, as I mentioned, the same fiscal rules apply. Now, some of the disadvantages of ETFs over traditional unit trust is, of course, stockbroking charges do apply when you're buying through a stockbroker. And due to the fact that they're tradable on an exchange, the instrument itself is subject to the forces of supply and demand. This can be seen as a benefit as well, where you may be able to get in when there's a slight dip. So it can be seen as a benefit, but due to the supply and demand dynamics, the price of the ETF will also fluctuate throughout the day. Now, as I mentioned, ETFs have really grown in popularity since, the first one was listed back in 1990 in Toronto. Since then, many more products, so many different strategies that are able to be accessed through ETFs. So the number of instruments and the assets under management in ETFs as a whole has just simply grows year on year. And in this chart, we haven't even gone back to the beginning, back to 1990. It just shows you how from 2003, there's so many more products and the assets under management of ETFs just continues to grow and grow every year. I included some of my favorite quotes about ETFs. Jack Bogle says, instead of looking for the needle in the haystack, you should just buy the haystack. And this really talks through the thinking, between active and passive management. Instead of trying to think, which stock is really going to, shoot the lights out, which stock is going to be the next hot thing on various exchanges. Instead of trying to, look ahead and think about, which stock you think will be that one winner, why not just buy the whole basket of securities? As we know, it is actually impossible to have a crystal ball and know exactly, which stocks in the next couple of years are going to be the big winners. Dave from ETF.com says, ETFs are fundamentally a technology. They're mechanisms to achieve a certain goal, like phones. Traditional mutual funds were rotary phones and ETFs are smartphones. So they do the same thing, but are in a better package. So this is a nice way to sum up maybe some of the differences between unit trust and ETFs. John Stein says that ETF portfolios will be the investable default for investors in the years to come. They're lower cost, they're transparent, and they offer great liquidity and tax advantages. And my favorite one from Martin Small at BlackRock, ETFs are not just having a moment. As you could see in that chart, it's not just 1 year that ETFs grew in assets under management globally, but this movement to passive investing, to simpler, more transparent securities is evident in local and global markets. So ETFs are not just having the moment, they're creating a movement. So why are ETFs so popular? So we've seen that assets under management in ETFs has grown. We've seen that there's constantly new products. We ourselves are launching a new product today. So there's new products that are constantly popping up. So why are they so popular? Well, one of the main reasons is the costs. Now, I was doing some research on various emerging market fund options available to South African investors specifically. And as much as I know that products are expensive, there's been so much pressure on fees in general that I could not believe my eyes when I saw that there are, emerging market type unit trusts or, India kind of portfolios that are tracking, other emerging markets. Some of these portfolios are 2.5%, 3% total expense ratios, really expensive. The portfolio or the ETF that we're talking about today comes in at a total expense ratio of 40 basis points. So it's a fraction of what some of these actively managed portfolios are charging. And then the argument is, do you really believe that by paying 2.5 or 3% for a product, that product will outperform the index? Well, I do have some data later on that will show you that history would tell us otherwise. So cost is a really big one. I mean, the more your investment portfolio costs you, the worse off you will be over the long term, because the good returns will be unfortunately reduced by what you're paying for that product. So costs, one of the main reasons why there's been such a movement into ETFs. Access, as I mentioned, you can access these through platforms, through stockbroking accounts, so you really do have various options. The beauty about ETFs that are tradable in South Africa, so these ones that we've listed on the JSE and on the secondary exchange A2X, the beauty about them, and specifically the ones tracking in the international indices, like the one that we are talking about today, is that investors, South African investors, can get global access without having to worry about exchange control. So you're sitting in South Africa, you're investing your rands, they're tracking offshore indices, so you have that exposure to all of these stocks outside of South Africa, but you don't have to worry about exchange control. And there are, of course, many other benefits. They provide diversification. ETFs are often diversified in themselves, which we'll see later on about this ETF. Because it's a basket of securities, there's diversification within the ETF, different sectors, different countries. So that in itself is diversification, but you can also diversify your own portfolio by entering by buying an ETF that tracks a different market, and you can create diversification that way. Of course, the transparency is a great benefit. You always know exactly what you're tracking. You can log onto our website, you can download the constituents, and you know exactly which stocks you are investing in. Now, back to fees. I mean, I told you that I myself recently, researched some of the fees for emerging market type funds. So this exercise was prepared by National Treasury to highlight the importance of fees specifically to retirement fund portfolios. So we know that retirement funds invest for a long-term horizon. And ultimately, the bottom line is that a regular saver who's able to reduce the charges of their account from 2.5% to 0.5%, which is totally doable if you think about what I've just said to you about some of the products that I saw available for South African investors. There's many products out there that are 2.5%, 3%. The portfolio or the ETF that I'm talking to you about today is at 40 basis points. So you can easily reduce the charges of your portfolio by 2%. So if you're able to reduce those charges from 2.5% to 0.5% annually, your benefit at retirement would be 60% greater after 40 years. So this just talks to the compounding effect and how fees really do eat away your return. So the higher the fee, the worse off that you will be over the long term. So it's really important to have a focus on these lower cost products that from a performance perspective actually do just as well, if not better, over many periods of time. So the star of today's webinar is our new ETF. As I mentioned, in the name of the portfolio, it actually tells you what it's tracking. So it's called the Sygnia Itrix MSCI Emerging Markets 50 ETF. So what it tracks is the Emerging Markets 50 ETF. So what is this product? Let me summarize it for you quickly. So it's a high risk, passively managed index tracking fund. Why is it high risk? It's high risk because it is investing into global equities. So because it's investing in global equities, by definition, equities are, of course, riskier than money market or bonds. So it's a high risk fund. It's passively managed because it tracks an index, and it is registered as a collective investment scheme, and it's listed on the Johannesburg Stock Exchange today as an ETF. So the objective of this ETF is to provide easy access to South African investors who want to achieve long-term capital appreciation, and they do so by tracking the MSCI Emerging Markets 50 Index. So how we do that is we replicate the price and yield performance of this index, the MSCI Emerging Markets 50 Index, and we do that by holding the stocks in the index as closely as possible in similar weightings. So the ETF tracking the MSCI Emerging Markets Index. So what are emerging markets? Well, emerging markets is a term used to describe the economies that are between the developing and developed stages. So developed economies are economies such as the US. If you think about the Eurozone, countries like Germany, these are developed economies. Now, your developing economies are economies such as Angola, Malawi. So those types of economies are further back from countries such as ourselves. But countries such as ourselves are not quite there like the US, for example. So it really is that in-between stage between being developing, so you have developed already, but you're not fully developed. So those are emerging markets. And we find ourselves in an emerging market ourselves. So South Africa is an emerging market. So I hope just by thinking of where South Africa is compared to the US and compared to other countries that are maybe further behind in development, that should give you a good idea of what emerging markets really are. So it's countries such as South Africa, Brazil, China, India. These countries are emerging market countries. Now, despite volatility, so emerging markets tend to experience, volatility from time to time. This is due to them moving through this, developing stage through to the emerging market stage, and then, becoming developed in the near future. So as you're moving through the stage, there's policies that change, certain regulations that change, politics play a role as you go through these developmental phases. And that can cause volatility, but despite their volatility, due to the growth potential of emerging markets, really the highest returning stocks are found in the fastest growing economies. And this is what we're trying to achieve here today, is to provide you with a product where you can invest in emerging markets, and over the long term, you will be investing in the fastest growing economies, and I will try to display that today. And then over the long term, these fastest growing economies will have stocks that will do very well over the near term. Now, ETFs are a great way to invest into emerging markets. You don't have to worry about opening stockbroking accounts in Taiwan and in Korea and in China and trying to trade in those accounts. You can simply buy an ETF with your South African rands, and the ETF will track the performance of these emerging market stocks. So I mentioned growth. So growth is really key when it comes to emerging markets. Now, on this chart, we're looking at the growth projections by the IMF that they made in various periods. So let's focus on the latest on this chart. So the latest predictions that they made is the 2021 growth projection, and that was as of June of 2020. Now let's have a look. Where do we see the highest numbers for 2021? Well, the highest number that I spot is the 7.4. So this is the growth projection by the IMF of emerging and developing Asia. Now, when we unpack the ETF a little bit more in the next couple of slides, you will see that it's heavily weighted towards these Asian economies, which is a good thing because they are projected to grow the most over the next couple of years. This is a summarized view, again, data from the IMF, and you can see that the global economy is set to grow by 6% this year and 4.4% next year. But if you have to split where the growth will come from, will it come from the advanced economies like your US and your Germany's, or will it come from emerging markets and developing economies? And you can see when you split it into these, more developed versus less developed, you can see that the growth really will be coming from the emerging markets. Now, splitting that out a little bit further into the various regions, where will the growth come from? Again, where do you see the highest numbers for 2021 and 2022? Well, the highest numbers are again here, emerging and developing Asia. So it's really this region of the world that is of interest. There's a lot of growth potential there that we'll unpack shortly. And this is really, if I want you to take anything away from today, is that this ETF is very exposed to these specific economies, so the emerging, developing Asian economies. And it's a good way for South African investors that want exposure to this growth region to be able to invest in this ETF and have exposure to this region of China and Asian economies. Another study that was performed by Standard Chartered Bank, they looked at how various economies will grow, in the next decade to 2030. And you can see that, they predict that the biggest growth will be China. And, in the study and in the paper that they prepared, they said, the emerging markets of today are the powerhouses of the future. So that's a really good way to summarize why you want to, invest in some of these more or less developed countries today, because as they go through this developmental phase in, the next couple of years, or may take longer, but in a decade or so, they may be what the US is today. And China, you could argue already there, they actually attracted more foreign investment than the US last year. So they officially overtook the US in attracting foreign direct investment. And in 2020, they're the only major economy that managed to grow. Every other economy contracted. They dealt with the pandemic very quickly, in lockdown, out of lockdown, back to, producing and back to almost, full mobility very, very quickly. So let's talk a little bit about China. So China, as I mentioned, so they dealt with the pandemic very quickly and very efficiently. They issued 5-year plans. So now they have issued their 14th 5-year plan. And what their main focus is here is they really want to be seen as the next, innovator. They are focusing on research and development, especially in new technologies such as AI, quantum computing, in the semiconductor space. And they plan to increase their spend on research and development annually by 7%. So they're really spending money on this research and development, and they want to be seen as this innovative power economy. They do have other important elements that are important to the growth of the economy, so you can read about some of them at the bottom. But, for example, they want to keep urban unemployment rate within 5.5%. They want to, continue to urbanize their population, to increase the life expectancy of Chinese people or Chinese citizens. They, want to promote green development, which is huge, especially when it comes to a country that has been polluting for so many years. So they really seem to have their 5-year plans going in the right direction, and they're growing. They already are, as I mentioned, even in 2020, where every other economy around the world contracted, they still managed to provide positive growth numbers. So definitely powerhouse of a country that cannot be ignored from a destination perspective. And again, when thinking about this ETF and the fact that it really is centered around, China and the Asian economies. From the World Bank and IMF data, they predict that by 2024, which is in the next couple of years, that 4 of the 5 largest economies in the world will be Asian economies. So again, not just China, but looking at the other Asian economies. Of course, China is a big one, and it's really driving that appetite for emerging markets. But some of the others as well are really going through that phase of moving from, developing to developed, and they're really set to be some of the biggest economies in the world in the near future. The growth of the middle class is an important aspect when it comes to emerging markets. And any market actually in general. It's really the middle class that consumes, so they really are key to positive GDP growth in the economy. So a strong middle class provides a strong consumer base, and it's really, this middle class, the middle class populations of countries are the ones that are key factor in also encouraging, good, policy changes. So the growth of the middle class is also an important item to consider. So I've shown you all of the growth projections by the World Bank, by the IMF, by, companies such as Standard Chartered Bank. So that's all good and well that we look at that, but then let's look at, the middle class demographics as well. So at the moment, or in 2020, if you looked at all the middle class people in the world, 54% of all the middle class population of the world was in the Asia Pacific region. Looking forward to 2030, we can expect that 65% of the world's middle class population will be in these Asian economies. So again, just another item that goes hand in hand with growth. We know that the middle class really is that driver of economic growth, but it's just showing us that the predictions by the World Bank and IMF, they are predicting that that's where the middle class will grow the most. So what can you expect from this ETF in terms of top 10 holdings? Well, the index, as I mentioned, that we'll track is the MSCI Emerging Markets 50 Index. So it's focused on the 50 largest, most liquid emerging market stocks. So it is a market cap weighted index, meaning that, the bigger a company grows, the further up it will be in terms of ranking of those 50. So the companies, it should be no surprise that the companies that have done very well over the last little while are the top holdings in this ETF. So it's companies such as Taiwan Semiconductors, it's Tencent that we know all too well, it's Alibaba, Samsung is another household name that we're all familiar with. Our very own South African Naspers is on the list of top 10. And then from a sector perspective, if you look at the last column, you can see that it's a lot of, infotech, communication, and consumer type of shares. Now, looking at the top holding, which is Taiwan Semiconductors, this share has, performed phenomenally well, which of course is a good thing for the ETF as well, as it's a large holding in the ETF. Now, Taiwan Semiconductors are the second largest producers of semiconductors in the world. They have done phenomenally well, and semiconductors are something that's used in pretty much all electronic devices. So as the middle class grows and there's more and more people that need, smartphones and various, household electronic devices, there's more and more demand for semiconductors. So a leading analyst that took, a little sentence or two from his latest report, an international analyst, and what he had to say about Taiwan Semiconductors. And he said it's a leading foundry in the semiconductor industry, and it's investing massively in its business. It's boding well for revenue and earnings growth over the long term. It's got a reasonable valuation at the moment, according to his opinion, and therefore it is attractive for long-term investors. Now here, ourselves, Sygnia Asset Management, as passive investors, we're simply tracking an index, but the idea here was to show you that, one of the top holdings is a great stock that a lot of, other asset managers are looking at and wanting to get into, because of the great growth that it has had up to now, and looking ahead at the semiconductor industry as a whole, again, an industry that's only but expanding. Now with ETFs, as I mentioned, you're buying into a basket of securities. So you're buying just one instrument, but you get exposure to, 50 stocks. These stocks do change from time to time as the index is rebalanced. And by buying into this ETF, you're sure to, at any stage, always be holding the top 50 emerging market stocks. So as one falls out, another one will be added in. The weighting does change from time to time, and it's our job to then track that index as closely and as practically as possible. But if you said, well, I don't understand ETFs, well, I hope that's not the case, but if you had to say, I don't understand ETFs, but I do like, these Asian economies and China and emerging markets, let me buy the stocks myself. Well, firstly, you would have to open up accounts all over the place and try to trade in these different markets, which is not always very easy. Then the price of some of the shares are so expensive and in different currencies. So this chart is just to show you, even if you just had to replicate the top 10, not even the whole 50 that we're tracking in this index, it would be very difficult. You can see some of the prices are very high. I mean, the NASPA share alone is over 3,000 Rand. Some of these other currencies, you may have to check, what the exchange rate is on the day and try to, trade in these different markets, which is not very easy. Whereas with the ETF, we, leave all of that difficult work to us. We've got accounts and we're trading in all of these markets, and you can just buy that one instrument that is tracking all of these stocks. And you can do so from as little as 500 Rand a month. So we've seen some of the top 10 holdings. We have looked at the growth potential, especially in the China and Asian economies that are predicted by the World Bank, IMF over the next couple of years. What can you expect from a sector perspective and a country perspective? Well, from a sector perspective, this is very much driven by the stocks that have done well and the top holdings. So at the moment, we can see that the largest allocation in terms of sectors is to information technology, followed by consumer discretionary and communication services. But overall, you do have exposure to various industries, and that is why the ETF in itself is very well diversified, because you do have stocks that are in healthcare or in financial services, along with the ones in information technology. So very well diversified in itself, but the largest weighting at the moment is to the information technology sector. From a country perspective, you can see that it's about 50% exposed to China. So this is great. There's so many papers out there that talk about, the growth of China and what a powerhouse of an economy they are and how they're only set to grow over the long term. So what a great way to, have exposure to this growth of the Chinese economy by investing in an ETF in South Africa. But if you have to add up China, Taiwan, and South Korea, just looking at these Asian type of economies, over 85% of the holdings in the ETF are actually exposed to these Asian economies. Hence my focus when looking at the growth of the various regions of the world, why I focused on Asia, and we saw that, really those economies are set to grow the most over 2021 and 2022. So from a sector and country perspective, definitely a tick in the box, in my opinion, of the type of exposures that you can expect as an ETF investor into the specific product. So let's have a look at the performance. I'm going to focus on the Rand returns. We are South African investors. And of course, the exchange rate does play a role when you're investing outside of South Africa and you bring that return back in Rand. But nevertheless, let's focus on the Rand return. So let's look at it over the 1 year. The MSCI EM50 index, this is the index that we are tracking with this ETF that's launched today. Over the last year, giving us 22.68%, outperforming the broader emerging markets index. So the broader emerging markets index is, much bigger in terms of holdings or the number of holdings, but the EM50 uses the broader emerging markets index to take the 50 largest, most liquid stocks. So it's a more tradable version of the MSCI emerging markets, the much broader index, and it has outperformed it over the last year. And the MSCI ACWI, that's the all country world index. So this index is very heavily weighted towards developed markets with a small exposure to emerging markets. So this is really just to show you that over the last year, already emerging markets are actually outperforming the developed markets. So as much as the All Country World Index does have some exposure to emerging markets as well, the split is about 90% developed markets, 10% emerging markets. So it's very heavily weighted towards developed markets. Looking at it over the longer term though, if we look at it over the 10 years, you can see how developed markets, had you been invested in these different products over 10 years, developed markets would have done better. But it's really, on the shorter term, the last year emerging markets have outperformed. And then looking ahead, where is growth coming from? Where can we expect the fastest growth from? Which regions? And looking ahead, definitely the emerging markets are set to grow a whole lot more than the developed world. Looking at just emerging markets, so we haven't included the All Country World Index here. So just comparing, the red line is the index that we are tracking in this ETF, whereas the gray line is the broader, bigger emerging markets. The less tradable version of emerging markets is the gray line. And you can see, as we expect, they will move in line. But since 2016, 2017, the red line is comfortably above the gray line, showing you that this index, that's the more tradable version, just focused on the 50 largest, most liquid stocks of the broader emerging markets index, has actually outperformed over the last couple of years. And it's really this red line is what we're tracking with this ETF. So when can you access this ETF? Well, it's tradable on the JSE from today, and it will be tradable on A2X on the 21st of May. So it is available from today if you wanted to trade it on the JSE or on the Sygnia platform or various other platforms. Now, why Sygnia's ETFs? Well, when it comes to managing ETFs, we've got a long-term experience in passive investing in general, which I'll take you through shortly. But when it comes to tracking of international indices, so ETFs that track the performance of indices outside of South Africa, we pride ourselves as being the only manager in South Africa not to be making use of feeder funds. Now, some of our competitors, they do make use of feeder funds. What that means is that instead of them buying and selling all of the underlying securities themselves, they rather buy into a BlackRock or an iShares, one of the international passive houses that has an ETF, and they wrap that ETF as a feeder fund, and they have it available here for South African investors. That adds a whole layer of fees. It impacts the spread. There's many other costs that can rack up in that type of structure. Whereas we are taking out that whole layer of fees, we're investing directly, we're able to control costs, and we work with a market maker that is huge, successful in many geographies around the globe. They've got offices in New York, London, Hong Kong, Amsterdam, and they operate and trade around the clock. So this relationship with our market maker is what enables us to have very deep markets and tight spreads of our ETFs. And passive investing in general, to me, it just makes sense. As I displayed to you a little bit earlier on by looking at that paper that National Treasury prepared of the impact of fees, I mean, low management fees when it comes to passive investing is key. Passive investing has delivered top performance, which I will show you. You're no longer limited with what you can and can't invest in. The product offering when it comes to passive investing is simply massive. When you're investing in ETFs, you can have efficient and immediate implementation. And as we have seen, this growth in products and AUM of ETFs around the globe, it shows us that top investors worldwide are opting for passive, simple, and transparent solutions. So looking at data from S&P, looking at this data, it will show you that over the last number of years, that passive has not only won the fee debate, but it has also won the performance debate. Fees are really the only thing that we can control upfront. None of us have a crystal ball to be able to tell you what your return of your portfolio will be in June, in July, or what it will be for 2021. We, practice risk management in our solutions, where we try to position ourselves for our current market environment, but returns is something that, nobody can guarantee upfront. But what you can control as an investor upfront are the fees. So by opting for passive solutions and ETFs, you're able to control upfront what you're paying for that product. And these surveys that I'm showing you here that you can look at yourself, and I've included the link on the slides, are S&P surveys, and they show us that in the United States, 75% or over 75% of active managers have underperformed the passive indices. In South Africa, not too different. 93.5% have underperformed if you measure it over a 5-year period. In other regions, not too different. In Canada, looking at it over a 5-year period, 98.63% of active funds have underperformed. In India, over 80%. In Europe, over 70%. So what we're looking at here is the active managers that have underperformed the passive, meaning that a very small percentage have actually managed to outperform. In Australia, the picture doesn't look any different. So all around the globe, active managers are continuously struggling to beat the performance of simple, low-cost, passive solutions like ETFs. And then for the 10 or 20 or 30% that happen to outperform across any period, well, what are the chances then that you pick the right asset manager? We know with single managers that their performance is unpredictable, just like the performance of any other portfolio. It's unpredictable upfront. Single managers tend to have different processes, philosophies. They see the world very differently. They try to also differentiate themselves from one another by having these different views of the world. And their processes and philosophies are such that not every manager will be able to outperform in every market environment. So I'm by no means speaking on Alan Gray, but it's a very well-known asset manager. It's a household name. You see their billboards at the big cities and the airports. So looking at Alan Gray from 2007, you can see that sometimes they're somewhere in the middle. In 2008, they were the top performing fund, but back in 2009 and 10, they're all the way at the bottom in terms of ranking. Then in 2011, there we go again, top performing, then they go up, they go down. And this is just to show you that it's physically impossible to upfront be able to choose the top performing managers for when you're looking ahead. Because if you're investing today, you're looking ahead. You want to know that what you invest today will hopefully be with the best asset manager tomorrow. And what we're saying is, don't worry about trying to pick the best stock or trying to pick the best manager. Just invest in the market. Do so at your lowest possible, fee for the product that you're looking at. And, if you invest for the long term and you're investing in markets that have huge growth potential, then, the returns will come. At Sygnia, we've had a long, history of passive investing in general and innovation in the space as well. So back in 2003 is when we fully replicated local equity and bond indices. In 2008, we launched the listed property index tracking fund. In 2012, we launched risk profile global balance fund that were passive and low cost. In 2015, we launched balanced international passive funds. So again, a really low cost way to access the offshore markets for South African investor. In 2016, we launched a thematic passive fund, such as the Fourth Industrial Revolution Fund, as well as our FANG fund, which has been very, very popular. In 2020, we continued with the innovation by launching our Health Innovation Fund. And in this year alone, we have already launched an ESG-focused global equity fund. Today's launch of the Emerging Markets ETF, and then our Healthcare ETF is the next one that we will be launching. And when it comes to, international indices or ETFs that track international indices, Sygnia is the largest provider of international index tracking funds in South Africa. And what do the headlines say about the active and passive debates? So I've included a number of headlines here, and you're welcome to, have a look at all of them, but I will just highlight, a few of them, what they have to say about the active and passive debate. This one over here says the priciest active investment funds perform the worst, study finds. Investors flee active funds at the highest rate in 3 years. 2020 will not be kind to active fund managers. And 2020 was an interesting one. It's active managers that would claim to have the ability to protect you more on the downside when markets are volatile, because by investing in the index, there's no active decision making. You're simply tracking the index. That's why we're able to do so at low cost. But what 2020 showed us is that our passive funds held up quite nicely and outperformed a lot of active managers when we saw those scary dips in, April of 2020, for example. And looking at our offshore ETF offering, we have a number of regional equity funds. So we've got the MSCI World that gives you exposure to global developed markets. We've got the Eurostoxx 50 that's focused on Eurozone companies. We've got the MSCI Japan if you wanted specific regional exposure to Japan. We've got the MSCI US, so it tracks the performance of US companies. The FTSE 100 is UK companies. The S&P 500 is the 500 largest stocks listed across various exchanges in the US. The S&P 1200 ESG ETF is the one that we launched on the 12th of April. So it has been going for just over a month now. And this one has that ESG focus, so that focus on environmental, social, and governance factors. And then the one that we're launching today, that's already tradable on the Johannesburg Stock Exchange, is the EM50 ETF. We also have, apologies to flip back, we also have the offshore specialist fund. So we've got a global property fund, the Fourth Industrial Revolution ETF, and the next one to be launched is focused on the healthcare industry. So it's very exciting. From a performance perspective, how have our ETFs performed? Bearing in mind that the rand has actually strengthened against the US dollar over the last year. When you experience rand strength, when you convert that foreign return back into rands, the rand return will look worse. But the opposite is also true. When the rand weakens and you invest in offshore markets, converting it back into rands will impact positively. So looking at performance over the 1 year, we can see that some of our ETFs have really shot the lights out, like the Fourth Industrial Revolution Global Equity ETF giving us 62%. I've also included our 2 local ETFs. So as much as most of our ETFs are tracking global indices, we also have 2 ETFs that track local indices. So the one is the Swiss 40 ETF and the other one is the Top 40 ETF. And they have done very well, delivering 27 and 31, just over 31% respectively. So performance has been great. And what is the next one to come? So it's the Sygnia Itrix Solactive Healthcare 150 ETF. Again, in the name of the fund, we try to explain what you can expect. So this ETF will track the performance of the 150 largest, most liquid healthcare stocks. So it's pharmaceutical companies like your Roche and your Johnson & Johnson's, the biggest 150 pharmaceutical companies listed in developed markets, and we're going to track the performance of those 150 stocks. There's been a lot of interest in the market ever since we launched our Health Innovation Fund last year, and our clients came to us and said, can't you launch something similar, but, address it in an ETF? And that is the reason why we are launching this healthcare ETF. And I truly believe that ETFs are here to stay. They've grown in popularity. They continue to grow in popularity. Investors around the world are becoming more and more comfortable with these instruments that operate so efficiently, and I truly do believe that ETFs are the future. I'll be happy to take any questions. I see that there are some questions in the question box, so I will try answer a few of them in the next couple of minutes, and whoever I don't get to today, I will answer you directly over email. How often is it rebalanced? It's rebalanced quarterly. Will there be dividend distributions? And if so, will it be biannually? Yes, just like our other ETFs, this will be a distributing ETF, and you can expect distributions in June and July of every year. Let me scroll down. When will it be available on Easy Equities? As far as I'm aware, it should be available today on Easy Equities. Hi, Eva. Please explain what exactly an index is and tracking an index. So an index is a segment of the market, and that segment could be equities, it could be bonds, it could be just the top 40 stocks, it could be a certain sector like industrials or resources or financials. So to make it simple, let's think about a property index. So if you look at all of the stocks on the JSE, they operate in different businesses. Some are involved in mining and resources, others are involved in telecommunications, but some are property stocks. So their businesses are property. They might own lots of malls and commercial properties, and they get their incomes from rentals. So if you think about all the property holdings, and if you had an interest in tracking property, then a property index will simply measure the performance of only the property holdings. So forget about all the resources and telecommunication stocks. That is an index. So it's an index is measuring the performance of either a broad sector or a very niche sector of the market. And how you track an index, if you had an ETF that is tracking the performance of the property index, for example, the way that the ETF tracks the property index is by buying every single underlying holding. So if there's only 10 companies, for example, in the property index, Sygnia will go and buy every single one of those 10 companies in the same weighting. So if one has a weighting of 5%, another one has a weighting of 3%, etc., we would buy it in that weighting. We would rebalance it as and when we need to. So we pay index providers for their data. So they provide us data regularly so that we make sure that we're tracking the index by buying the underlying holdings in similar weightings as far as practically as possible. So that is the way that we track an index. We're simply replicating it by buying all the underlying holdings. There's no active management involved. So there's no thinking of, do I like this property company more than another property company? If it's in the index, we buy it. Same goes for this emerging market ETF. The index is made up of 50 of the largest, most liquid emerging market stocks. What will we physically do? We're going to buy those 50 stocks in the same weightings that I showed you. For example, I showed you the top 10. We'll buy it in the same weightings, we're trading in the various markets, and that way, by purchasing our ETF, you have exposure, and your ETF will move up and down as the performance of those 50 stocks goes up and down. Would you please send me the full portfolio composition? So with index data, it's a little bit of a tricky thing. We pay for the index data and we pay for that exclusive use of that index data. So can't share the exact the index data that we get. But once the ETF is up and running, on our website, if you go to the Sygnia Itrix range, and you're welcome to email me and I can send you the link. If you go to that part of the Sygnia website where you can view details and fun fact sheets and marketing sheets of the full Sygnia Itrix range, if you click on a certain ETF, for example, the Fourth Industrial Revolution Global Equity ETF, you will be able to look on the right-hand side and you'll see NAV performance as well as constituents. If you click on constituents, it will download a file and you can see every single stock in there. So if you're investing in this one, in the MSCI Emerging Markets 50 ETF, the Sygnia one, you will be able to also log onto our website. You will be able to click onto that ETF, scroll down, look on the right-hand side, you'll find constituents, and there you'll be able to use or have a look at which 50 stocks are there. I showed you the top 10, but there is 50. Does the 40 include VAT? Yes. So it's a total expense ratio of 40 basis points inclusive of VAT. Okay, so in terms of ethical investment, how does Sygnia make sure that the companies are ethical and green, especially because China and the East are known for pollution? So unfortunately, in this case, we cannot make sure that. We are simply replicating an index. If a stock is included in the MSCI Emerging Markets 50 index, we will include that stock in our ETF. But as I showed you in the 14th five-year plan of China, there is a big focus on being green over the next couple of years, and there's a major focus all the way around the world. But to answer your question simply, there's no way for us to be able to impact what is in the index. It's a market cap weighted index. The stocks in emerging markets that are doing well and if it becomes one of the 50 largest stocks, it will be included in the index and we will then buy it. When can we buy this on our online share trading? So if you have a stockbroker account, it's tradable on the JSE today. If you search for the share code, you should be able to find it. The share code is SYGEMF, so SYGEMF. So if you type that into your share trading platform, wherever it may be through, you should be able to find it. This is great, but still investing in rands, correct. When are you going to have a direct offshore platform? Cannot commit to a date, but watch this space. It is investing in rands. There are, of course, pros and cons. We have to remember that, for most of us, this is where we live. This is where our expenses are. And already, although it's in rands, the exposure that you're exposed to, I mean, we live here, we have our big assets like our homes in South Africa. We've got, big chunks of our retirement fund monies that have to be invested in South Africa due to regulation. So we're already so exposed to the South African market. And by being able to invest in ETFs that track offshore markets, it does provide that diversification. Although, yes, you are bringing it back. If you do withdraw, it will be back in rands. But there's also a benefit to that, is that you don't have to worry about exchange control and, reaching those limits. Can you please show us steps on how to buy this ETF on the Sygnia platform? I've had issues before. Can I please ask you to email me and we can get something to help you step by step? I noticed that none of the top 10 companies are Indian. Given that India is said to be the second biggest economy, this is strange. Any plans to have an Indian ETF? So we've got lots of plans on new ETFs that we are launching. I cannot share all of the information on what we're launching until we've had approvals from various regulatory bodies, but we're always thinking about and innovating in the space. But to answer you why some Indian stocks are not in the top 10, for example, it really comes down to market cap. So India is an emerging markets country. It is, of course, from a regional perspective, included in this ETF, but it just so happens that none of the top 10 are emerging markets at the moment. But maybe we look at it in 6 months' time and one of the Indian stocks will be in the top 10. So it's an element of market cap, who is the largest, and that's how the ranking works in terms of the top 50 holdings. Another question on which 50 constituents. So they haven't been loaded onto the website yet, but I'm explaining where going forward you can expect to see these. So once it's up and running and well, it is tradable from today, that's where you'll be able to find the information on the full 50 constituents. So not there today if you look today, but if you're interested in any of the other ETFs or you invest in any of the other ETFs, that's where you can find the information. We are out of time, so there's quite a bit of questions here. It says yours is the EM50 index, Itrix is based on the broader emerging markets, that's correct. Is it available on stockbrokers platforms today? It should be. Okay, I think I will stop here. We are 1 minute past 12 at the moment. And if you've already typed your question in this box, then I will have it. And together with your email address, I will respond to you directly. If there's something that you think about a little bit later on, please feel free to email me and I will get back to all of your questions. So thank you for listening to me today. And please do join us for the launch of our next one. Keep an eye on your inboxes. We'll let you know as we get closer and closer to a listing date of our healthcare ETF that's coming next. Thank you.